Good afternoon, ladies and gentlemen. I'm very pleased to meet you all again here today to share with you our performance for the first quarter of the year. But before we start, let me introduce executives who are with me today on the panel. To my right, Dr. Sompravin, our Chief Economist. Dr. Sompravin just recently joined us as the Chief Economist. And to my left, ML Jiradet. Kun Jiradet is our Chief Credit Officer. And we also have key executives who are joining us online, starting from Dr. Yan Yong. Dr. Yan Yong is our Chief Wholesale Officer. And Kun Ora is our Chief Retail Officer. Kun Pikun, our Chief SME Officer. Kun Poramasiri, Chief Insurance Business Officer. Dr. Chari, Chief Digital Banking Officer. And lastly, Kun Krieng, our Chief Risk Officer, who is joining us this time online. So we will proceed with what we normally have by asking our Chief Economist to spend 10 minutes to give us a rundown of the latest macro update for the economy. Please, Dr. Sompravin.
Good afternoon. As we have started this year with a hope that the pandemic would fade away and countries would gradually open up, service activity would kick into the growth alongside with manufacturing activity. Yet, things has changed dramatically since February 24th, when Russian-Ukraine war started. And actually, there are two main messages in my talk today. First, the global economy is facing with new major headwinds, Russian-Ukraine war and potential more aggressive policy tightening in advanced economies. This would limit upside growth going forward. And my second message is that the Thai economy is recovering from the pandemic. Yet, what happens in external environment, as I mentioned before, pose downside risk to the economy. SCB recently revised down our GDP forecast of Thai economy from 3.2% to 2.7%. We still believe that Thai economy is still on its recovery path, yet fragile and uneven. We maintain our view on the BOT interest rate to remain at 0.5% for the rest of this and first half of next year. And let me walk you through this briefly. First thing first, the outlook of the global economy. On the right-hand side box, you can see that we are more cautious on the world economy because there seems to be more risk with higher degree of impact comparing to the upside. First, Russian-Ukraine war, as we know, give a surge in energy price, escalating inflationary environment from the supply side. In addition, manufacturing and trade activities could be disrupted if sanctions become more severe. And central bank, another factor is central bank in advanced countries start to have a rate hike, combining with this faster than expected inflation pressure. Tightening, we could see more aggressive, leading growth normalization sooner than expected. And lastly, living with COVID in China do some damage or add some uncertainty as well, because cluster outbreak every now and then cause a hiccup in manufacturing industry over global supply chain. And on the left-hand side, as you can see, that we have a projection of global growth at 3.4%. We already take into account impact from Russian-Ukraine war. At 3.6 and 3.2% respectively. And let me touch a bit on the Russian-Ukraine. When we look at the size and exposure of Russian to the world economy, we know that it's not large, very small, but the type of activity that plays role in global supply chain is important. That involve upstream activities, which disruption could potentially spread through activity along the supply chain. And exposure to European countries is also important. We know that recession from Russia and Ukraine themselves do not derail the recovery. But if it translates to EU, a recession, that would be a different story. Well, we still don't see that going to happen, but it's just a tail risk that we have identified. Therefore, transmission channel on the right-hand side, I will not go into detail here. Let me skip to Thai economy. In this changing environment, both unintentionally, intentionally, would limit upside growth of the world going forward. And we know that Thai economy is largely driven by the stance of the world economy, and therefore we cut GDP growth from 3.2% to 2.7%. And you can see that it's happened almost every component of our GDP. Kindly note that on the right-hand side chart, pre-COVID level of activity will be back again by third quarter of next year. That's postponed by 1 quarter from our previously forecast. Let me point out some of the key remaining drivers of the Thai economy. That's good news. First, tourism industry it will gradually recover from the pandemic. Although we revised down our tourist arrival number from 5.9 million to 5.7 million, but that's very marginal, and it's reflect a hiccup from the war. But this number is actually much more significant improvement from last year by 10-fold. Source of tourist arrival would be coming from ASEAN and European countries. And when we look at this Omicron and vaccination rate around the world and in Thailand, it's imply less stringencies. And although we not fully open our country yet, but it allows some domestic activities to be carried out. And we also believe that domestic tourism will play important role. We are looking at around 180 million trips this year. That's account for around 80% of pre-COVID level of 230 million trips this year. And second growth driver is still coming from export. Although we have a growth slowdown, upside from business cycle plays less role, but we believe that structural factor, including asset ratification, demand shift toward electronics, and substitution effect from Russian-Ukraine war could provide cushion to the Thai export as well. So the number would be around 6% growth, and that could translate to a private investment growth around 3.5%. And lastly, we talk about inflation and the rate. And you can see here that our inflation has been largely driven by cost push inflation from the supply side, and where lower income household took a harder effect on this higher price spiral because consumption basket concentrated on energy and food. And these people are majority of Thai people, and which could limit private consumption as well, because real income could drop this year because higher inflation. And as we mentioned, we are looking at around only 2.9% of private consumption, cut by half point from our previous forecast. And therefore, my last slide, given all of this fragile and uneven recovery, we believe that BOT will keep the policy rate put at 0.5% for the rest of this year. If what happens in Russia and Ukraine does not escalate to a significant manner, we see that the first rate hike would be towards the second half of next year. And that's all from my part. Thank you.
Thank you, Dr. Sampravin, for sharing his thought on the latest macro environment. So as you notice, first quarter was yet another very challenging quarter for us, but we managed to maintain our overall performance resilience. Earnings growth, as you have noticed in our release during noontime, has come off on a year-on-year basis. We had a decline in non-NII revenue, but with some offsetting impact by credit cost reduction on a year-on-year and Q-on-Q basis. Asset quality remains under control, and we have good progress in terms of digital business as digital engagement, digital loans, and digital revenue continue to grow substantially on a year-on-year basis. We are pleased to learn that with the results of share conversion, based on our preliminary data, the share swap acceptance ratio exceeded 99%. And we are coming out with official data very soon, probably tomorrow. So I think that's the key message for our result release for this time. So let me go directly into to discuss asset quality. From this quarter onward, we will focus on the progress of the blue scheme restructuring under the comprehensive debt restructuring framework that was part of the Bank of Thailand's policy. The reason that we choose to focus on blue scheme is that it is this blue scheme that reflects the real and deep restructuring efforts whereby banks will need to sacrifice EAR upfront to sustain customers' long-term survival, whereas the orange scheme is simply a typical restructuring. So for us, as we coming out of the relief program, which are short-term driven into a longer-term focus CDR program, we will maintain our focus on the blue scheme restructuring. So for this year, we estimate to have a total of around 350 billion baht worth of customers to come into the blue scheme restructuring. That is about 15% of our total portfolio. So far, we have got about 249 billion baht of the customers coming into the program already. So that means that we have another about 100 billion baht of customers that we will need to execute during the rest of the year. So within this 249 billion baht so far in our blue scheme program, the majority is in corporate and followed by retail customer segments. For the corporate customer segment in the blue scheme, the majority would be our hotel customers. To be exact, hotel customer makes up about 3/4 of our corporate customer in the blue scheme. So if you recall, we highlighted that in the release last quarter that the overall impact from the blue scheme restructuring would be around 10 basis point NIM sacrifice on the overall portfolio. So far, what we have seen, we believe that the impact to our NIM is still well within what we have earmarked for from the beginning. In fact, it is actually slightly better than what we expected from the original expectation. At the end of last year, we had around 397 billion baht of customers in the relief program. So now as we transition into this long-term debt restructuring, you can see from this chart that roughly 60% would go into this blue scheme restructuring. So the rest will move into normal portfolio, including orange restructuring, but the majority of that would be going to the normal portfolio. Of the 249 billion baht of customers in the blue scheme program, most would be in stage 1. As you would imagine, typically we wouldn't provide blue scheme assistance to customers who become NPL. And then under the Bank of Thailand's framework, banks are allowed to bring customers under the blue scheme restructuring back to stage 1. However, we do have around 13 to 14 of customers in the stage 2 for blue scheme customer, simply because as our normal practice, we are applying some judgment and we are not bringing everyone back to stage 1 just as a matter of prudent practice. And we do have small percentage of customer still in the stage 3. This is as a result of qualitative downgrade that we carried over from the relief program. So you can see that outside of the blue scheme, stage 1 customer should be well exceed 90%. So I think that's the profile of the customers asset quality that we are working with at the moment. So we believe that asset quality remains well within control. And we believe that unless the macro environment becomes much worse from here, we are on a gradual improvement in terms of asset quality. Digital engagement and digital revenue has also grown quite substantially. At the end of the first quarter of this year, total number of digital users across all platforms that we have in the group amounted to a total 21.4 million users, and this represented a growth of 39% on a year-on-year basis. The increase is actually coming across the board. SCB EC app, Robinhood now registered a number of users, almost 3 million users by the end of the first quarter, with a significant increase in the merchants signed up in our platform. And we also have good growth for the other smaller platforms that we have, for example, Monix, SCB Abacus. So digital revenue grew 88% on a year-on-year basis to reach 1.5 billion baht for the quarter. It is still below 5% contribution to the overall revenue, but we certainly expect this contribution to become bigger, larger in the future. Just a few words on the process of share conversion. Right now, we already complete the share conversion process, and I pointed out early on that based on our initial data, more than 99% of shareholders have accepted the tender offer. Then it means that the SCBX share will start trading on the Stock Exchange of Thailand on the 27th of April. And with that, we should be able to upstream the one-off special dividend of 61 billion baht from SCB Bank to SCBX to start new business, to fund asset transfer and also new investment sometimes in the middle of this year. But this is still subject to final approval by the Bank of Thailand. At the moment, we are working on different scenarios, different kinds of stress tests to make sure that with the upstream of the dividend, bank will remain safe and sound with whatever capital level that we have, which I can mention to you later on that with the level of capital that we have, 61 billion baht upstream, our overall capital level should remain rather healthy and remain comparable to our major peers. Now, moving on to the first quarter results. As I mentioned, we had a decline in non-NII, but nonetheless, our NII actually is holding up quite well, and our NIM is also has been holding up above 3%. We still continue to manage our expense prudently. Cost-to-income ratio remained at the low 40s, at about 42% for the first quarter. Credit cost dropped on a year-on-year and Q-on-Q basis, but this level of credit costs included precautionary buffer against inflation headwinds. As you heard from Dr. Sompravin, we downgraded our GDP from 3.2% to 2.7%, and there is an increasing inflation headwinds. So we want to be prudent on this matter. So we are not able to go back in terms of credit costs to the pre-COVID level yet. Our pre-COVID level credit costs would stand around 130 basis point. All right, right now, our credit costs still stay relatively elevated at around 151 basis point. Asset quality improved slightly with NPL ratio dropped to 3.7% and NPL coverage gone up to around 144%. And in terms of capital position, remains very strong and solid. So let me go directly to key P&L items to discuss key P&L items. First with NIM and yield. Overall yields on loans and NIM drop on a Q-on-Q basis. And this is because of the impact from the comprehensive debt restructuring, as we have been highlighted. The impact is basically we have a full quarter impact more or less in the first quarter of this year. And as we progress with the long-term debt restructuring to around 350 billion baht towards the end, there's probably still some pressure in terms of NIM. But I think we are pleased to see that the impact is not as big as what we originally expected. So we were looking at NIM to stay at around 2. The guidance is 2.9% to 3%. So it looks like we should be able to maintain our NIM for the year towards the high end, upper end of the range. On a year-on-year, though, we have NIM and yields improving on both a year-on-year and Q-on-Q basis. Remember, in the first quarter of last year, we had a widespread lockdown measures throughout the country, in many areas in the country. So business activities were quite low, and we were still under the relief program measures. So we got quite a number of customers coming to us for TDR, short-term restructuring. Versus at the moment, business activities already came back. So we are able to take a more constructive view on the customers' long-term ability to pay, and that impact our EAR estimate for our customers in the relief and also assistance program. So that's why we have a year-on-year improvement in terms of yields and NIM. And you may have noticed that we also have been trying to manage our cost of funds. Our cost of funds has been on a constant downward trend. In the first quarter of this year, cost of deposit dropped 2 basis points, and we have higher mix of CASA coming in the first quarter of this year versus the fourth quarter of last year. So these have helped our cost of funds and our cost of deposits. So all in all, a NIM 3.04, a downward drop of 8 basis points on a Q-on-Q basis. On the left-hand side chart, you notice that the drop in yields by segment, retails, SME, are mainly because of the impact of the CDR. Retail is a little bit more than SME because of some of the impact from the housing portfolio, blue lane restructuring of the housing portfolio. Corporate segment, the yield has been stabilizing at around 3%, in fact, up a little bit, despite the fact that we got a large hotel portfolio that we provided rather deep restructuring for the blue lane. But it has been our intention to tighten up our pricing and also risk return criteria. So I think we have been trying to do this for some times already. So I think the impact help offset, and in fact more than offset the downward trend from the CDR. But not, the impact is still there. But I think we got offsetting impact from the fact that we have been tightening our pricing and also risk return consideration. Our loan business will continue to focus on flight to quality strategy. We will not be aggressive to grow our loan book. Will be very much guided by stringent, if not more stringent, risk return criteria and consideration. For the first quarter of this year, we managed to grow corporate loan quite a bit on a Q-on-Q basis, up 3%. And retail and SME loan up a little bit. On retail loans, the main growth was coming from a housing portfolio, whereby we grew our housing portfolio by about 1 percentage point. SME loan up by 1 percentage point, which is quite a good number, considering the fact that we didn't have much new soft loan booking in the first quarter of this year versus the previous quarters last year. So I think this is still a pretty a good number to have. So overall, loan growth on a Q-on-Q basis, 2%, versus our loan growth expectation for the whole year, 3.3 to 5%. I think it depends on how the macro environment, macro backdrops progress over the year. We are trying to achieve our target, but still we will be guided by risk and return consideration. NPL has shown some sort of improvement. Overall NPL dropped from 3.8% at the end of last year to 3.7% this year. And we have observed a drop in new NPL formation in the first quarter of this year at around 12.2 billion baht versus almost 17 billion baht in the fourth quarter of last year. And versus the first quarter of last year, it was also a meaningful drop in terms of new NPL. The reduction in new NPL formation was more obvious in the corporate and SME, whereby we see noticeable reduction in the new NPL formation, whereas we still need to keep closely monitoring the new NPL formation for the unsecured personal loan segment. But that is a small part of our overall portfolio. For the retail segment, in the secured segment, the new NPL formation has been somewhat stabilizing. So I think overall trend, I think so far, when the country opened up their economic activity, business activities have improved, have been recovering. So we see some positive side in terms of asset quality. Stage 2 has came down, as I mentioned early on when I discussed the blue scheme debt restructuring. We migrated some of the customers from stage 2 back to stage 1 when we provided them with the blue scheme debt restructuring, even though we still kept some based on our judgment. But it does mean that our stage 2 on an overall basis has declined from 8% mix last year to around 5% mix this year. But if we strip out the blue scheme, the stage 2 mix in the normal portfolio, including orange scheme, would be well below 5%. I think that's the overall scheme that we are working on at the moment. In terms of the stage 3, 106 billion baht, we just want to point out that we didn't do much of the qualitative assessment this year in the first quarter, very small. So the cumulative qualitative NPL outstanding made up about 40% of our total NPL outstanding at the moment. And we have noticed that new NPL formation has improved very much across the board. I touched upon the way we look at provision a little bit already. 151 basis point, equivalent to 8.8 billion baht for the quarter, compared with 12 billion baht in the fourth quarter of last year. In the fourth quarter of last year, we actually topped up around 2 billion baht to take care or as a buffer against the Omicron situation. 8.8 billion baht remains rather elevated, even though it is a decline from last year, just to take care of the inflation headwinds. Without inflation headwinds concerned, we probably can go lower than this based on our asset quality and based on our blue scheme restructuring. But for now, we want to be prudent and conservative. Now, going forward, we will continue to make assessment as to the need for any provision top-up. So based on macro environment and the change in inflationary pressure, which means commodity prices margin compression and so on and so forth to our customers and business portfolio. NPL coverage has improved to around 144%. I think our appetite somewhere above 130% should be good enough, but I think we have built up our buffer quite a bit under this environment. Non-NII overall showed a decline on a Q-on-Q basis and 10% down Q-on-Q, and also 10% down on a year-on-year basis. Let me first talk about non-recurring non-NII. Dropped 37% Q-on-Q and dropped 77% year-on-year. We had around 2.3 billion baht. Still, more than half of that non-recurring non-NII was contributed from mark-to-market gain from investment through SCB 10X. So that remains a critical contribution to our non-NII. But given the market sentiment, capital market environment in the first quarter, we had about around 400 to 500 million baht of loss, including FX valuation in the first quarter of this year on the bank investment portfolio. It is a small loss, but nonetheless, it is a loss in the first quarter. So that's why non-recurring non-NII stood at about 2.3% and show a drop on a year-on-year and Q-on-Q basis. Now, moving on to recurring non-NII, small decline Q-on-Q and year-on-year. What we want to highlight is that bank assurance business remains very resilient. Up 1% Q-on-Q and small drop on a year-on-year basis. We have introduced a new flagship product, OPD Savings, which has been well received by our customers. And we believe that with uncertainty, probably there would be more demand for insurance products. And we also ramped up our sales force. We started to see small contribution coming in from SCB Protect, which is our insurance brokerage subsidiary under the bank. We have been preparing for this for some time already, but we had some hiccup last year during the pandemic and lockup, whereby during which we couldn't really ramp up our business operation. So we started to see a little bit of improvement coming in from that in the first quarter of the year. So bank assurance business remain our key focus, and we will continue to grow bank assurance business through digital channel. Now, moving on to wealth business. Obviously, with the capital market environment in the first quarter, we had a big drop, even though we're trying to adjust our mix and also adjust strategy to find suitable, to find products or funds that are suitable for the current market environment. But still, it is a drop 9% Q-on-Q and a drop of 26% on a year-on-year basis. In particular, on the year-on-year basis, the first quarter of last year saw a very good market sentiment. So I think that's why we have a rather big drop on a year-on-year basis. And I also want to highlight that we continue to see good improvement on transactional banking fee. Transactional banking fee in the first quarter up both on a Q-on-Q and year-on-year basis. And this is as a result of business activity recovering on the back of relaxing lockdown measures versus last year. So I think we should continue. We should be able to expect this to continue going into the second quarter of this year, and hopefully this is the trend for the whole year to continue to be the same. Cost control and management is very important for us. In the first quarter, our CI ratio was about 42%. We had some increase in certain cost segments, but in some of the segments, we have a reduction. Employee cost has came off across Q-on-Q and year-on-year basis, but we do have some increase in premise equipment and marketing in particular on a year-on-year basis, simply because we have more business activities recovering and there is spending to be incurred. But on an overall basis, we will continue to maintain cost discipline. We are targeting CI ratio for the whole year at low to mid 40s. I can share with you that without SCBX restructuring, our cost base will be at a low 40s. But there is some cost that we need to be incurred in terms of SCBX for SCBX restructuring, both in terms of new business set up and also new system set up to support a new investment, and not to mention some ongoing deals that we are working on at the moment. So we'll be coming out with a new guidance once SCBX is officially up and running, and we are ready to announce the business plan to investment community later on. Probably that will be sometimes in the middle of this year. Liquidity is not an issue for us. In fact, too much liquidity is something that we need to manage and optimize. LD ratio 93%. CASA mix has gone up quite a bit. So I think we're trying to optimize the excess liquidity that we have to probably have some improvement in our yield on earnings asset in the second quarter and third quarter of this year. Capital position remains very strong. BS ratio 18.6%. As I mentioned early on that by the middle of this year, we're going to upstream around 61 billion baht of special dividend to SCBX. So that's would made up about almost 3 percentage point. So 18.6% less about 3 percentage point. Then the bank would still be with total capital ratio of around 15 to 16%. So we are right now doing all different kinds of stress test scenarios to make sure that this 15 to 16% total CAR ratio would be sufficient for bank to run on a safe and sound basis in the long run. So I think that we should get final approval by the Bank of Thailand sometime in the second quarter of this year. Now, lastly, this is the last page of my presentation. In terms of the business outlook for the rest of the year, it is unfortunate to have inflation spike when we have small growth. And as Dr. Sampravin mentioned, you heard the word fragile, uneven. Impact to banks could be quite widespread. If we are really talking about persistently very high inflation environment, from loan growth to asset quality to fee income prospect. So under this uncertainty, rising uncertainty, global geopolitical risk, we continue to be prudent and cautious. We want to be take a proactive and cautious approach towards our managing our balance sheet and asset quality. Our strategy with SCBX is precisely to address this issue by looking for new growth areas to invest and to unlock values to create long-term and sustainable value. But for the banking business, our strategy, which has been approved by the board, to become a better bank, in the sense that we will optimize our business portfolio and to maintain cost discipline and lower cost to serve, and to make sure that we have quality growth, and we will not be growing simply to grow our loan book or to grow our top line. We want to make sure that we have the right and good quality growth. So that concludes my presentation for first quarter results.